Friends, thank you for being here today. We live in an era of noise. Turn on the television, open a newspaper, or scroll through a financial news feed, and you are bombarded with a cacophony of conflicting opinions. We are told by pundits that the economy is resilient. We are told by politicians that a soft landing has been engineered. We are told by financial advisors to simply stay the course because the market always recovers. But today, I want to step away from the noise. I want to step away from the optimism of the morning talk shows and the sensationalism of the evening headlines. I want to invite you to look at something far more quiet, far more boring, and yet infinitely more significant. I want us to look at the paperwork. Specifically, I want to discuss a document that appeared in the Securities and Exchange Commission's filing system just a few weeks ago. It is known as Form 13F. It is a quarterly requirement for institutional investment managers with over $100 million in assets. Usually, these forms are routine. They are clerical necessities that are skimmed by junior analysts and largely ignored by the general public. However, the filing submitted by the Bill and Melinda Gates Foundation Trust was not routine. It contained a piece of data that should stop any serious investor in their tracks. In a single quarter, the trust sold 2/3 of its Microsoft holdings. Let us pause to appreciate the gravity of that sentence. This was not a trim. This was not a standard portfolio rebalancing to free up some liquidity for charitable grants. This was a liquidation. Bill Gates, the founder of Microsoft, the man whose name is synonymous with the company, directed his foundation to exit the majority of its position in the tech giant. If this were an isolated incident, we might be able to rationalize it. We could attribute it to philanthropy or estate planning, but it is not isolated. When you pull back the lens and examine the filings across the entire landscape of America, ultra-wealthy, a chilling pattern emerges, a pattern so consistent, so coordinated, and so utterly at odds with the public narrative that it implies a unified conclusion among the world financial elite. Over a recent 6-month period, billionaire insiders, the smart money, have liquidated approximately $89 billion in publicly traded securities. They are selling, they are raising cash, and they are doing it now. While the S&P 500 is hitting all-time highs, and the retail investor is being told that the party will never end. Today, we are going to forgo the speculation and focus exclusively on the facts. We will analyze verified SEC data, historical market valuation metrics, and the specific macroeconomic indicators that these billionaires are seeing. We will answer the question, why are Bill Gates, Warren Buffett, Jeff Bezos, and Jamie Dimon quietly selling everything? And more importantly, what does their exit mean for your retirement portfolio in the coming months? To understand the magnitude of what is happening, we must look beyond the abstract number of $89 billion. And examine the individuals behind the transactions. These are not day traders reacting to a chart pattern. These are the titans of industry, the individuals who built the companies that drive the American economy. They have access to data that you and I do not. They see real-time consumer spending, supply chain orders, and credit trends months before they appear in government reports. Let's begin with Jeff Bezos. In a span of just 9 trading days, the founder of Amazon sold $8.5 billion worth of Amazon stock. To put this into context, prior to 2019, Bezos had never sold more than $3 billion worth of shares in an entire year. Yet, in less than 2 weeks, he unloaded nearly triple that amount. This was a sale of 50 million shares, executed with a speed and urgency that suggests panic selling disguised as liquidity management. When a founder sells that aggressively near all-time highs, they are not creating cash for lifestyle expenses. They are capitalizing on a valuation they likely believe is unsustainable. Then there is Mark Zuckerberg. The CEO of Meta, formerly Facebook, offloaded $500 million in shares. While Zuckerberg has sold shares periodically in the past, the timing here is what matters. He is selling into a rally driven almost entirely by the hype surrounding artificial intelligence, a topic we will analyze in depth later. He's monetizing the optimism of others. But perhaps the most alarming signal comes not from the technology sector, but from the banking sector. Jamie Dimon, the CEO of JP Chase, sold $150 million worth of the bank's stock. Why is this significant? Because this is the first time Jamie Dimon has sold shares of JP Morgan since 2005. Think about what that timeline represents. Jamie Dimon steered the largest bank in the United States through the great financial crisis of 2008 without selling. He held through the European debt crisis. He held through the COVID-19 pandemic crash of 2020. For nearly 2 decades, through every market gyration, he held his position. Now, in 2026, after 18 years of holding, he has decided it is time to sell. As the head of JP Morgan, Dimon sits atop a mountain of proprietary economic data. He knows the health of the American consumer better than the Federal Reserve does. He knows exactly what is hiding in the commercial real estate loan books. He knows the default rates on credit cards and auto loans before they make the news. If Jamie Dimon is selling for the first time in 19 years, he is not diversifying his retirement. He's engaging in exit planning. He is signaling that the risk-to-reward ratio of holding bank stocks, and perhaps stocks in general, has shifted unfavorably. When you aggregate these moves, Gates, Bezos, Zuckerberg, Dimon, and the Walton family, you see an 89 billion vote of no confidence in the current market levels. The financial media has worked overtime to rationalize these sales. They tell us it is for tax purposes. They tell us it is for philanthropy. They explain it away as routine estate planning. And while these explanations may be technically true on the surface, they deliberately miss the point. The critical question is not why they are selling. The critical question is why now? Why did they not sell 2 years ago? Why not wait another year if the soft landing is guaranteed? The synchronization of these sales tells us that they are seeing cracks in the foundation that the rest of the market has ignored. I'd be curious to know if you are sensing this disconnect in your own daily life. Does the economy feel as resilient to you as the news claims? Or are you seeing the same cracks the billionaires are seeing? Let me know in the comments. So, what exactly are they seeing? If we look at the same data sets available to institutional investors, 5 specific signals flash red. These are the indicators that history tells us precede major market corrections. The first and most immediate concern is valuation. The price you pay for an asset determines your return. It is a fundamental law of investing that seems to have been forgotten in the current euphoria. Currently, the S&P 500 is trading at approximately 22.2 times forward earnings. To the uninitiated, this number might seem arbitrary. But to a seasoned investor, it is a siren. The 5-year average is 20. The 10-year average is 18.7. We are trading at a significant premium to historical norms. According to FactSet Research, the S&P 500 has only sustained a forward price-to-earnings ratio above 22 during 2 specific periods in the last 40 years, the dot-com bubble of 1998 to 2000 and the post-COVID stimulus bubble of 2020 to 2021. We know how both of those stories ended. The dot-com bubble burst in March 2000, leading to a 49% decline in the S&P 500. The COVID bubble deflated in 2022, resulting in a 25% drop. When the market trades at 22 times earnings, it is priced for perfection. It assumes that earnings will grow flawlessly, that interest rates will come down, and that the economy will avoid recession. Any disappointment, any deviation from the perfect scenario causes a repricing. The billionaires know that trees do not grow to the sky. They are selling because the math simply no longer makes sense. Beyond valuation, there's a massive driver of the current market rally that warrants close scrutiny: the excitement surrounding artificial intelligence. Companies like Microsoft, Nvidia, and Alphabet have seen their valuations soar on the promise of this technology. However, a look under the hood reveals a concerning divergence between spending and profitability. Take Microsoft as a prime example. In its most recent quarterly report, the company touted revenue growth of 16% year over year. The headline number was strong. But if you looked at the free cash flow, the actual cash the business generates after capital expenditures, it fell by 7%. Why? Because Microsoft, along with Amazon and Google, is engaged in an arms race. They are spending tens of billions of dollars on AI infrastructure, data centers, GPUs, and energy solutions. They are betting the farm that AI will generate massive returns in the near future. But what if it doesn't? Or more likely, what if the returns take a decade to materialize? We are seeing a classic capex cycle peak. History is littered with technologies that changed the world but bankrupted the initial investors. Think of the railroads in the 1800s or the fiber optic cables in the late 1990s. The internet eventually justified the fiber optic networks, but not before the crash of 2000 wiped out the companies that laid the cable. The billionaires are selling into the AI hype because they recognize the risk of this profit paradox. If AI turns out to be another metaverse, a capital sinkhole, valuations will collapse. The third signal comes from the structure of the market itself, which is arguably the most concentrated it has been since the Nifty 50 era of the 1970s. The top 7 stocks, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla, account for roughly 32% of the S&P 500's entire value. This creates a dangerous structural weakness in the market. Passive index funds, which millions of Americans rely on for their 401ks, are forced to buy these stocks simply because they are big. It is a self-reinforcing loop on the way up. However, it becomes a liquidation cascade on the way down. If a hedge fund needs to raise cash, they sell what is liquid. They sell the biggest winners. As Apple or Microsoft begin to fall, index funds are mathematically forced to sell them to rebalance. This pushes prices lower, triggering more selling. The smart money understands market mechanics. They know that when the exit door is narrow, you want to be the first one through it. And while the stock market grabs the headlines, the fourth signal comes from the bond market, where the truth is often found. Corporate America is facing a wall of debt maturities. During the COVID era, companies borrowed trillions of dollars at near zero interest rates. It was virtually free money. But corporate bonds have terms, usually 3 to 5 years. That debt is now coming due. Debt that was rolled over at 1% in 2020 or 2021 is now being refinanced at 4% or 5% in 2026. This is a quadruple increase in interest expense. Consider a company that operates on thin margins. At 1% interest, they are profitable. At 4% interest, they are insolvent. We are already seeing bankruptcies rise and high-yield credit spreads widen. The billionaires, particularly those like Dimon with insight into credit markets, see this refinancing cliff approaching. They are exiting equities before the credit contagion spreads to the broader economy. Finally, the fifth signal is found in the sentiment of the insiders themselves. In December 2025, the ratio of insider sells to insider buys hit 4.7 to 1. For every share of stock a corporate executive bought in their own company, nearly 5 shares were sold. This is the highest ratio since 2007, immediately preceding the Great Financial Crisis. Corporate insiders are supposedly the ultimate cheerleaders for their companies. They are the ones telling you on earnings calls how bright the future looks. Yet, their personal brokerage accounts tell a different story. They are not eating their own cooking. If the captains of the ships are putting on life vests, passengers should take notice. It is not enough to simply know that the billionaires are selling. To protect our own wealth, we must look at where they are moving that money. They are not stuffing billions of dollars under a mattress. They are rotating into specific defensive assets designed to withstand a depression. Let us look closely at Bill Gates' portfolio adjustments. After slashing his stake in Microsoft, a high-growth technology stock, where did he allocate capital? Let's look at the first key holding, waste management. Gates holds over $7.5 billion in this company. Why trash? It is the ultimate defensive asset. The economy does not dictate garbage production. Whether GDP is growing at 3% or shrinking at 2%, households and businesses produce waste. Furthermore, waste management has a moat. You cannot simply start a new landfill in a major city. The regulatory barriers are insurmountable. This gives the company pricing power. When inflation rises, they raise prices. When the economy slows, their volume remains stable. It is unsexy, it is boring, and it is safe. Alongside this, Gates is heavily invested in Canadian National Railway. This rail network is the only one connecting 3 coasts in North America. Railroads are the arteries of the global economy. They move the grain, the coal, the oil, and the chemicals that keep society functioning. Like trash collection, this is a tangible asset with high barriers to entry. It generates cash flow regardless of whether the latest iPhone app is successful. The third major pillar of this defensive strategy involves Berkshire Hathaway. Gates increased his holdings in Warren Buffett's conglomerate. This leads us to the Oracle of Omaha himself. What is Warren Buffett doing? For 3 consecutive years, Berkshire Hathaway has been a net seller of stocks. Buffett has sold heavily out of banks and, most notably, slashed his position in Apple by roughly 50%. And what is he buying? Treasury bills. As of the end of the third quarter of 2025, Berkshire Hathaway sat on a cash pile of $325.2 billion. Let that number sink in. $325 billion? That is more than the market capitalization of Disney, Pfizer, or Coca-Cola. Buffett is holding more cash than most countries have in their foreign reserves. Why? Buffett's strategy has always been, be fearful when others are greedy, and greedy when others are fearful. Right now, the market is greedy. Valuations are high. So Buffett is essentially in cash. He's earning a risk-free 5% return on that capital while he waits. He is building dry powder. When the correction comes, when the S&P 500 drops 30% or 40%, Buffett will be the only one with the liquidity to buy high-quality American businesses for pennies on the dollar. He's not predicting the end of the world. He is preparing for a sale. These billionaires' actions are not occurring in a vacuum. They are reacting to a deteriorating macroeconomic picture that contradicts the soft landing narrative. First, we can see that the labor market is cracking. The unemployment rate has ticked up from 3.6% to 4.2%. While 4.2% sounds low historically, the trend is what matters. This increase triggered the SOM rule, a recession indicator with a near-perfect track record since the 1970s. The rule states that when the 3-month moving average of the unemployment rate rises by 0.5% from its 12-month low, a recession is already underway. We have crossed that threshold. The labor market is the last domino to fall, and it has started tipping. Furthermore, the consumer is increasingly tapped out. The U.S. economy is 70% consumer spending. If the consumer stops spending, the economy stops. The data shows a consumer on the brink. Credit card delinquencies have hit 6.8%, the highest level since 2011. Auto loan delinquencies are at their highest since 2010. The personal savings rate has plummeted to 4.4%. During the pandemic, consumers had excess savings from stimulus checks. That money is gone. Now, facing inflation and high interest rates, they are putting groceries and rent on credit cards. This is not sustainable. When the consumer breaks, corporate earnings will collapse. At the same time, we are witnessing a slow-motion crash in commercial real estate. Office buildings in major cities are worth 30% to 50% less than they were in 2019 due to the permanent shift to remote work. This is a problem for the banking system. Small and regional banks hold the vast majority of these commercial loans. As property owners default, these banks face insolvency. This leads to a credit crunch. Banks stop lending to small businesses to preserve their own capital. This tightens the screws on the economy even further. Finally, we cannot ignore the instability on the world stage. Wars in Ukraine and the Middle East, coupled with rising tensions between the US and China, create an environment of deglobalization. Global supply chains are fragmenting. Tariffs and sanctions are increasing costs. For decades, globalization kept inflation low and profit margins high. That era is ending. A world of conflict is a world of lower profitability and higher volatility. Before we discuss the specific timeline of what comes next, we must confront the psychological trap that keeps the average investor paralyzed. While the billionaires exit, the seductive myth of the soft landing, and the illusion of liquidity. Every major financial crisis in history has been preceded by a soothing narrative from central bankers and politicians. In 2007, Ben Bernanke famously stated that the subprime mortgage crisis was contained. In early 2000, analysts argued that the internet had eliminated the business cycle. Today, we are told that inflation is vanquished and that the economy will slow gently without breaking. This narrative is dangerous because it appeals to our desire for stability. But the smart money knows that the Federal Reserve has a track record of being reactive, not proactive. They raise rates until something breaks, and then they scramble to fix it. The billionaires are not waiting for the official declaration of a recession. They are looking at the lag effects of monetary policy. They know that the full impact of 5% interest rates takes 18 to 24 months to work through the system. We are just now entering that window of maximum danger. I'm curious, do you trust this soft landing narrative? Or do your personal observations and history books suggest otherwise? Share your perspective below. Furthermore, there is a structural reason why Gates, Bezos, and Buffett are moving with such urgency. It involves a concept that is rarely discussed on cable news, the liquidity illusion created by passive investing. Over the last 15 years, trillions of dollars have flowed into passive index funds and ETFs. These funds are price insensitive. They buy stocks automatically, regardless of valuation, simply because cash is flowing in from 401k contributions. This has created a massive artificial floor under stock prices. It feels safe. It feels liquid. You can click a button on your phone and sell your shares instantly. But the billionaires understand that this liquidity is a mile wide and an inch deep. In a panic, when everyone tries to sell at once, the passive flows reverse. The automatic buyers become automatic sellers. And because active managers, the people who actually value companies, have been decimated, there is no one left to step in and buy the dip until prices fall 30% or 40%. This explains why Jeff Bezos sold $8.5 billion in Amazon stock in just 9 days. It explains why the Gates Foundation liquidated 2/3 of its Microsoft position in a single quarter. They are front-running the liquidity crisis. They know that the exit door is much smaller than the entrance. They are securing their cash now while the market can still absorb the selling volume. If they waited until the crash started, their own selling would crash the stock further. They are exiting a burning theater while the audience is still watching the movie, because they know that once the fire alarm rings, the stampede will trample anyone who is still in their seat. This is the asymmetry of the market. The retail investor thinks about volatility, the daily ups and downs of the market. The billionaire thinks about permanent loss of capital. They are willing to miss out on the last 5% of gains to avoid the 50% drop. They are not seduced by the soft landing fairy tale because they have studied the history books. They know that soft landings are the unicorns of finance, often talked about, but rarely seen in the wild. Based on the data and the positioning of the smart money, we can project a potential timeline for how this scenario unfolds. While no one has a crystal ball, the cycle of market crashes follows a familiar psychological pattern. We are currently in the first phase, which we can call complacency. The market remains near highs. The media celebrates the resilience of the economy. Retail investors continue to buy the dip, believing the Fed has their back. Meanwhile, the insiders continue their quiet, methodical selling. They are distributing their stock to the public while liquidity is still abundant. Sometime in the next few months, we will likely enter the second phase, the fracture. A catalyst will emerge. It could be a disastrous earnings report from a major tech company, perhaps Nvidia or Microsoft, revealing slowing AI growth. It could be a regional bank failure linked to commercial real estate. This event will cause volatility to spike. The buy the dip strategy will fail for the first time in years. The S&P 500 pulls back 5% to 10%. The media will call it a healthy correction, but the internal market breadth will deteriorate rapidly. As economic data worsens, we move into the third phase, the realization. Unemployment hits 5%, consumer spending contracts, and the narrative shifts. The soft landing talk vanishes, replaced by hard landing fears. Corporate earnings estimates are slashed. The Magnificent Seven stocks, previously thought invincible, lead the decline as index funds liquidate. The market falls 20% from highs. The recession is officially declared. Finally, we reach the fourth phase, capitulation and opportunity. This is the bottom. Retail investors, watching their retirement accounts shrink by 30% or 40%, finally panic and sell. They vow never to touch stocks again. Sentiment is universally negative. This is the moment Buffett, Gates, and the prepared investors have been waiting for. They deploy their billions in cash. They buy the high-quality assets that the panicked public is selling. They plant the seeds for the next great bull market, transferring wealth from the impatient to the patient. So what should you do? If you are 25 years old, you might simply close your eyes and keep buying, knowing you have 40 years to recover. But if you are over 60, if you are retired or nearing retirement, you do not have the luxury of time. A 40% drawdown in your portfolio right now could permanently alter your standard of living. However, panic is not a strategy. Prudence is. Here are the steps you should consider taking immediately to align your portfolio with the smart money. First, you must assess your reality. Look at your portfolio today. If you have blindly followed the 60 from 40 rule or are heavily invested in S&P 500 index funds, you are holding the exact bag the billionaires are dropping. You are overweight technology and overweight the most expensive stocks in history. You do not need to go to zero, but you must reduce your exposure to the bubble. Take some chips off the table. If you have enjoyed the gains of the last 2 years, capture them. Unrealized gains are vanity. Realized gains are sanity. Second, do not be afraid to raise cash. For years, we were told cash is trash because interest rates were near zero. That is no longer true. Short-term treasury bills are paying around 4.5% to 5%. This is a risk-free return. By holding a significant portion of your portfolio, perhaps 15% to 20%, in cash or cash equivalents, you achieve two things. First, you earn a steady income without market risk. Second, and most importantly, you gain optionality. When the market eventually corrects, cash transforms from a defensive shield into an offensive weapon. It gives you the power to buy when everyone else is selling. Third, you should rotate to defense. Follow Bill Gates' lead. Move capital out of high-flying growth stocks and into the boring, essential infrastructure of the economy. Look for companies in utilities, consumer staples, healthcare, and waste management. These stocks often pay healthy dividends. In a bear market, dividends become the primary source of return. They cushion the fall. Fourth, it is critical to eliminate leverage. If you have a margin account, close it. If you are trading options, stop. Leverage acts as a multiplier. In a bull market, it multiplies gains. In a bear market, it multiplies destruction. When volatility spikes, brokerages raise margin requirements. This forces traders to sell assets at the worst possible time to cover debts. Do not put yourself in a position where you can be forced to sell. Fifth, consider an allocation to physical assets. Paper assets, stocks and bonds, are claims on future cash flows. Physical assets are value in themselves. Allocating 5% to 10% of your portfolio to gold, silver, or productive real estate provides insurance against monetary chaos. Gold, in particular, has historically performed well during periods of stagflation and crisis. It is a hedge against the uncertainty of the central banking system. I'm interested to hear your strategy. Are you raising cash like Buffett or holding on to gold? Let's discuss in the comments. And finally, perhaps the hardest part is to ignore the siren song of the industry. The financial industry is built on keeping you fully invested at all times. They get paid on assets under management, not on your peace of mind. When the market starts to wobble, they will tell you to buy the dip. They will tell you you can't time the market. But remember who you are betting against. Bill Gates is selling. Warren Buffett is selling. Jeff Bezos is selling. Jamie Dimon is selling. Are you smarter than they are? Do you have better data than they do? If the answer is no, then why are you acting differently than they are? Friends, the warning has been delivered. It did not come in the form of a press conference or a televised address. It came in the quiet, legal disclosures of the SEC. $89 billion in insider sales is not a coincidence. It is a consensus. The richest people on earth are preparing for a storm. They have secured their lifeboats. They have battened down the hatches. They have moved their wealth from the casino floor to the vault. Meanwhile, the music is still playing, the drinks are still flowing, and the passengers on the main deck are being told that the ship is unsinkable. You have a choice today. You can continue to listen to the noise, hoping that this time is different, hoping that valuations do not matter, and hoping that trees grow to the sky. Or you can listen to the silence. You can listen to the quiet, decisive actions of the men who built the modern economy. You can prepare. You can protect what you have worked a lifetime to earn. The air raid siren has been sounding for 6 months. It is hidden in the 13F filings, but it is screaming for those who know how to listen. The storm is coming. Do not be the person who looks back in 2027 and wonders why they didn't see it coming. You are seeing it right now. The only question left is, what will you do about it? Thank you.